Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing SoundHound AI stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, almost $1 billion market cap. They're trading at $3.82 a share, and they have 256 million shares outstanding. SoundHound is a voice, AI, and speech recognition company. It develops speech recognition, natural language understanding, and sound recognition software. Their main products include a voice AI developer platform, SoundHound Chat AI, a voice-enabled digital assistant, and a music recognition mobile app. Their products are used in the auto industry, in restaurants, and other customer service type industries. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year, so it is hard to value this company. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, which can never be negative. And you can see they have a steady growth, 13 million in 2020, up 63% to 21 million in 2021, up 47% to 31 million in 2022. And in the trailing 12 months, they're at 38 million. So not a lot of revenue, a really small number, but they're growing. And the hope is they're going to continue to grow into $1 billion company. At least that's the hope if you're invested in them. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 500 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $333 million. We divide that by 256 million shares. And we get a calculated stock price of 130. They're trading at 382, so they're trading at a 193% premium. It's a sell according to the model. I just don't have that much information to value the company. I'm using all the information I have, which is fairly limited. So don't get mad at me that I say the stock is overvalued, because I generally go out 4 years for my future free cash flows. Nobody can predict the next 10 years of anything, let alone a company like this. So it could be a good swing trade, but I do see more downside than upside. But if you're riding the AI boom, then you're probably really bullish on this company. There are 244 companies in the same industry as Sound. If they have a number in red, they're worse than the median. If they have a number in blue, they're better. In terms of CapEx, they spend a little less than $500,000, so they round to zero. But it's actually, I think, around $470,000 they spend, which of course is a lot less than the median and average because they're such a small company. They are pretty leveraged, which isn't a good sign, because when you're a small company, you don't want to use debt to grow. You want to use equity. Their debt to equity ratio is 3.5. For every dollar of equity, they have $3.50 of debt. They still have negative free cash flow, so of course that's worse than average. They rank 109th of the 244 companies, a little under 1 billion. Average is 8.7 billion. Median is 550 million. Price to book is really high at 32. Price to book is stock price over book value per share. PE is NA since they have negative earnings. PE is stock price over earnings per share. Price to free cash flow is NA since they have negative free cash flow. Price to free cash flow is stock price over free cash flow per share. Price to sales is a bit high at 26. That's stock price over sales per share. They're generating a lot less revenue as a percent of their market cap. relative to the average and median in the industry. They only have 38 million of revenue, and we can't look at their 5-year annual revenue growth rate. They haven't been public that long. Let's take a look at their most recent 10Q. We'll start with their income statement. This is the third quarter of 2023, the third quarter of 2022, the first 3 quarters of 2023, and the first 3 quarters of 2022. Revenue is up a little bit, 11.2 million to 13.3 million. Let's see if they give a breakdown of the revenue. Of the 13.3 million of revenue, 4.3 million is hosted services. That is down from last year of 4.9 million. What they mean by hosted services is allowing customers to access Houndify so they can access the software without owning it. Houndify is an open access platform that allows developers to leverage this company's voice AI technology. This includes a library of over 100 content domains, including weather, flight status, sports, etc. Their revenue from licensing is the highest, 7.9 million. That's up from 5.4 million. The difference between licensing is when they transfer the control to the customer. So the customer owns the software. Then they have 900,000 from professional services, 161,000 from monetization. So not that much revenue. In the trailing 9 months, it's only 29 million. Here's a breakdown of the revenue by location. 10 million in Korea, 200,000 in Germany, 900,000 in Japan, 1 million in France, 800,000 in the US, and 800,000 in other countries. Most of their revenue is from product royalties, 12.6 million, 500,000 from subscriptions, and 161,000 from monetization. Let's go back to their income statement. Revenue is up 19% from 3Q 2022 to 3Q 2023. Cost of revenue is up even more, up 39%. So their gross margins are down since cost of revenue went up more than revenue. Sales and marketing went down quite a bit, 4.5 million. That went down 33%. R&D is also down a lot to 12.8 million, down 34%. G&A 7 million, down 28%. So their operating expenses are down a lot from last year. Last year 38 million, now they're 28 million. So much better operating loss. A loss of 14 million compared to 27 million. They spend 5.4 million of interest on their debt. That's up 367% from last year. Their net loss is 20 million compared to last year of 30 million. That's just for 1 quarter. They did improve 10 million year over year. Their loss per share is 9 cents. Last year 15 cents. They're adding a lot of shares. Last year they had 197 million shares. Now they have 242 million. Let's look at their balance sheet. 109 million of current assets, 21 million of current liabilities. So their current ratio is above 5. They have a lot of cash, 96 million of cash, and they have 14 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. They talk about restricted cash in this section. The amount of restricted cash was established according to certain requirements under a credit agreement, and also leases for their corporate headquarters, data center, and sales office. If you become indebted to someone, like for instance, you rent office space, they may require you to have a certain amount of cash on hand at all times, as kind of like a security blanket. In case you run out of cash, at least you'll have that cash that you set aside. Total assets, 144 million, up from 38 million. Liabilities, 118 million. Their biggest liability is long-term debt, 83 million. They do have quite a bit of debt, and all of that debt is due in 2027. 100 million due in 2027, and then you have to minus 17 million for an unamortized discount. That gives them 83 million. The unamortized discount is a difference between the face value of the bond and what the company actually pays. If the company pays a fixed rate of interest, then this would be 0. But if the interest rate is adjustable, then this number could be positive or negative. Like say for instance, you had a home loan from 6-7 years ago with a 3% interest rate. Even though you owe $300,000 on that home, if you take into account the low interest rate, you owe less. Because there's really safe investments like money market investments that pay 5%. But if the opposite happened, you had a home loan where you're paying 8% interest and the going rate out there is 5%, then you actually owe more because you're paying such a high interest rate relative to the market. Of course, if you had a really high interest rate, you would just refinance the loan. When you take their assets minus liabilities, you get their equity, $26 million of equity. They raised $586 million from selling their business, and they lost $574 million from running their business. Let's look at their statement of cash flows. This is for the trailing 9 months. In their operating cash flow section, they lost $54 million. Last year, they lost $74 million. In their investing section, they don't spend too much in PP&E, $334,000. In their financing section, they have a lot going on. They added $25 million from selling preferred stock. They added $71 million in an equity line of credit. They added $8.8 million of common stock. They added $85 million of debt, and they paid back $35 million of debt. So in their financing section, they had a cash inflow of $155 million. Let's look at the stock on Simply Wall Street. Its last price, $382, $978 million market cap, up 69% in the past week, down 5% in the past year. Let's see what they say about the company. SoundHound AI develops independent voice artificial intelligence that enables businesses across industries to deliver high-quality conversational experiences to their customers. Their products include Houndify platform that offers a suite of Houndify tools to help brands build conversational voice assistants, such as automatic speech recognition, natural language understanding, wake words. A wake word is like a command. An example is when you say, "Hey Siri," that's a wake word to let your phone know you're going to say something. They also offer custom domains, text-to-speech, and embedded voice solutions. They were founded in 2005, 19 years ago, headquartered in Santa Clara, California. Simply Wall Street does not value this company. There are 6 analysts that price the stock at $4.43. Their revenue for 2023 is projected to be $47 million, 2024 $69 million, and 2025 $98 million. This red line shows their debt since 2020. It was $13 million. At the end of 2021, $60 million. At the end of 2022, $35 million. It's currently at its highest point, $83 million. And here's their equity. You can see it was negative at a couple of points. Now it's back to positive since they've been raising capital. They do have more cash on their balance sheet than debt, but their cash burn is pretty high. The CEO's annual salary is $381,000. So at least somebody at the company is making money. It's definitely not the investors. His total compensation is $10 million. He's been CEO for 1.8 years. There's a ton of insider selling. Doesn't look like there's any buying. This is in the past 12 months. It's a sell after sell after sell. So about 1.3 million shares have been sold in the past year by a lot of different people. 60% of the company is held by the general public, 22% by institutions, and 17% by insiders. The founder of the company is the biggest shareholder at 7.25%. The co-founder and CEO owns 6.5%. NVIDIA owns 0.68%. Masayoshi Son's SoftBank owns 0.4%. Their employee count is fairly steady. They're currently at 430. And the ticker only trades on the NASDAQ. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.